Hello and welcome back to the Note. We seem to have had a further outbreak of normality today after all the excitement at the end of last week over the Fed's non-event. A big part of that is that the Fed itself seems to be trying to move perceptions back. We've had various governors speak today. All of them have been trying to make a case that the rates could indeed rise by the end of this year. You've seen stock markets generally recover across the world somewhat. You've seen bond yields rise a bit again, as you'd expect if the interest rate climate is changing here in the States. And as for volatility, you can see that the VIX index is now almost back to normal, back down around the 20 level, far below the extremes that we saw when China was really scaring people a few weeks ago. I'd like to end, however, with one note of caution. If we take a look at this next chart, this shows us the performance of growth stocks compared to value stocks. The red line is for the Russell 3000 for US stocks. The blue line is for the MSCI World Index of stocks around the developed world. You can see that growth has pummeled value ever since the financial crisis, and that there has been another very significant leg worse for value, another significant leg of outperformance for growth stocks in the last few weeks. Now that's partly because when something is scarce, like growth is these days, then it will tend to command a higher price. But also, even though you don't think of the current conditions as being particularly bubbly, when value is doing badly, when stocks that are interesting because they're cheap do this badly for this long, it does suggest something strange is going on with the dynamics of the market, that there is something frothy there. There is cause for concern in the continued remarkable underperformance of value.